Welcome to the Minds Capital Podcast, the show devoted to the growing world of independent sponsors and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Max Lummis and Nicholas James. Today's conversation is with Richard Baum of Consumer Growth Partners. Max, what was the takeaway you had from our conversation with Richard?
Well, it's another of sort of the four main OG sponsors. So he's got tons of information, and I found this podcast episode to be really good, and it will be one that I'll recommend when I'm asked about the Minds Capital podcast. You know, folks always learning about the podcasts ask me, which episode should I listen to first? I think this is probably one of those because he covers so much ground in the podcast. I mean, he talks about, all the way back when independent sponsorship began developing through, how it's changed and advice for emerging sponsors and, the mentoring that they do for younger sponsors, which we're hearing as a theme. He talks about raising capital. He talks about a lot of the topics that we sort of hear about over and over on the podcast, but he talks about all of them in one episode, and he speaks very well about the different areas. So, if I had to focus on a couple items that I really found to be most useful, one area was using strategic advisory work as a means to find proprietary deal flow. I think that's excellent advice if somebody's in a position to do that, and I think a lot of independent sponsors are, based on their background. So we always talk about proprietary deals being superior in most cases overall to kind of banked or broker deals for independent sponsors. And so what's the edge, what's the niche, what's the foot in the door for finding these proprietary deals? I think strategic advisory for these businesses is definitely a great way to get in. So that was a good point that he brought up. And then, of course, Richard is focused on consumer and retail investing. And so this is another sponsor. I think we've had two or three lately that are focused on consumer. So it's got my attention because we've listened to it a lot lately. But he focuses on specialty retail. And I think there's a difference, obviously, between generic and sort of competitive non-durable retail versus this specialty retail segment, which may be more fragmented. He talks about Western wear in Texas and in the Southwest, and the business that they invested in focuses on rural areas, and they found a niche selling Western wear in these rural areas and kind of stitched a bunch of those together. So that's super interesting. But as we're talking about consumer and retail, I can't help but think about kind of what's going on right now in the economy. I think it's extremely bifurcated. I think you've got the S&P 500 doing really well, and it's at records, but at the same time, you've got credit card delinquencies at their highest level in 15 years. The consumer is obviously stretched. I think anything beyond a consumer durable or necessity right now is kind of a tough sell for me. Anything that involves discretionary spending, I think we got to be really careful about right now. So lots to think about, but it's a great episode, and I hope everybody enjoys it.
On that point of the offering advising as a foot in the door, of course, you'd have to become from the industry, have that industry specialization. And Richard talks at length about industry specialization, something that regular listeners will have heard before. But he did say something in passing that I caught because of my roots in entrepreneurship through acquisition, ETA, which is if you don't have industry specialization, he's very strong advocate for having industry specialization. That's part of the value that you bring to a deal. And so what about those people who don't? Or what about those would-be independent sponsors who want to buy into an industry maybe that they don't come from? So they're getting out of their industry, and so they can't claim deep specialization in their target industry. And he said something like, maybe that's what a search fund is for, or maybe those folks do search funds. And I have thought a lot about the difference between the independent sponsor model and the traditional search fund model. Talked about it a lot, thought about it a lot. In fact, the economics are quite similar. Call it 20 to 30-ish% carry. But I'd never heard this point so crystallized, that one reason to choose traditional search fund is if you approach your business buying career more as a generalist, or you want to get into a different industry. You don't want to stay in the same industry from which you come. I thought that was a really little interesting observation. Nicholas, did you have a takeaway?
Yeah, a couple of things actually. One is he talked about fundraising, and he emphasized, and we've heard this a few times now, so it emerges as a pattern that fundraising is not a one-off project. It's not only when you raise for a deal, it's something that you should do continuously. And so Richard was saying that they have a CRM with hundreds of investors that they have accumulated over the years, not necessarily active investors or people who've been in their deals, but investors that are interested in their deals. And they had them, I believe, in Salesforce. He also mentions HubSpot as a CRM, and others exist too. Then he goes on to say that on a quarterly basis, we reach out to about 10% of them to have touch points with them, keep these relationships warm. And then he says that conferences is a shortcut for him to connect with and touch base with a lot of investors in one go. And that's one of the big reasons why he goes to conferences. It's just a great place to not make new relationships only, but to maintain those that he already has. So encouragement to everyone to view fundraising as a core tenet of your independent sponsor boutique. I think this is another difference, of course, versus searchers who, for them, it is a one-time project. But for independent sponsors, it's something that you may do every year or two. And that really means it's a continuous thing. The other thing that he talked about was industry breakdown. And he said that 80% of independent sponsor deals fall within 4 categories: light manufacturing, value-added distribution, services, and healthcare. Why? Well, these have recurring revenue, they're asset light, and the valuations are reasonable. Some industries, historically SaaS, has been too expensive for searchers to raise money on a deal-by-deal basis. They've been priced out. I can think of other industries like property management is one that we historically haven't seen a lot of searchers in because multiples can be quite high. And I will also say, anecdotally, at Minds Capital, we're actually not seeing that many HVAC deals these days, where I have to imagine you would have seen a ton of them 5 years ago. And I think it's because the strategics have gone down market so far and are paying so much that they've in a way eliminated sponsors and searchers from going at least at large volumes after these targets any longer. Then he says the 3 R's that no one in private equity likes, which is retail, resources, and real estate. And he makes a case in the episode about why occasionally you should perhaps consider these, because you can buy them cheap because nobody else likes them. And so we always hear, what is the here that I can be comfortable with and where I can buy it cheaper because nobody else wants it. And he suggests that these shouldn't be blanket no's just because it's a resource, an oil and gas deal, for instance. It was a really great conversation. Thanks to Richard for coming on. I couldn't have enjoyed it more.
To your reference of the 3 R's, Nicholas, I'm reminded that Richard is quite quotable. He has colorful flourishes throughout the interview, so listen for those. We, of course, talk about the name change, the label change from Fundless sponsor to independent sponsor. That comes up with any guest who's been in the game long enough. But he put it more interestingly than we'd heard it before, where he said, Fundless sponsor sounded too much like homeless person. So that one I'll remember. Well, before we turn to the interview with Richard, a reminder that at Minds Capital, we invest equity into independent sponsor-led acquisitions. Our check size is $1 to $3 million per investment, and we average about a commitment per month. So if you're a sponsor raising equity for a platform acquisition, submit your deal to us at our website, mindscapital.co. Or if you're interested in investing in Minds Capital as an LP, there's a pre-registration form also on our website for investors. So if you are or can become accredited, fill out that form to be kept in the loop on future raises. Again, mindscapital.co. Okay, here is the Minds Capital podcast interview with Richard Baum of Consumer Growth Partners. Enjoy. Welcome to the Minds Capital Podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James. Newly acquired and PE-owned companies are high-value targets. Hackers time their attacks when teams are distracted by the deal, exactly when a breach can stall operations, bleed cash, and blow the thesis. Enzo Technologies is your full-service IT MSP for post-close stability. They assess your target, surface the biggest risks in plain English, and give you a day 1 through 30 plan to cut exposure, prevent downtime, and even find cost takeouts like bloated telecom bills. Check out enzotechnologies.com, INZO, or email CEO Nick Akers directly at nick@enzotechnologies.com. Having acquired Enzo himself, Nick understands the challenges sponsors and searchers face when transitioning a business. So make sure to tell him you're an independent sponsor and listener of the Minds Capital podcast. nick@enzotechnologies.com. Richard Baum is well known in the independent sponsor ecosystem. Richard grew up in a retail family where his father was involved in the shoe business. Richard studied law but never practiced it, instead pursuing a career in retail. This career began at BCG when they had fewer than 100 consultants. It included long stints at big brand retail companies like Bloomingdale's and culminated in a CEO role at a specialty retail company with 40 stores. Richard then became an industry-focused equity research analyst on Wall Street, working for Goldman and other financial institutions. This was his entry point into finance. He had the operational skills, the industry expertise, and now the understanding of capital markets to co-found Consumer Growth Partners, the independent sponsor firm for which he is now known in our world. Richard Baum, welcome to the Minds Capital podcast.
Well, thank you, guys. I really appreciate you having me here. I'm really looking forward to this conversation.
Richard, when you first tried to raise a fund, an investment banker convinced you to raise money on a deal-by-deal basis instead. What was it that he said that persuaded you to go that path?
Well, the simple reason is that it was a matter of time. My co-founders and I, back in 2005, initially intended to raise a fund. And we spent about 18 months doing this and eventually discovered that we were known as an emerging fund. And anyone who did, and the reason we were called emerging is because we did not have an attributable track record. So my partners came out of private equity. I came out of equity research. And so we did not have an attributable track record. And what we learned is that about over 98% of all the capital that goes into private equity goes into folks that have either had a prior fund or have an attributable track record where they are currently. And so it was very difficult for us to raise institutional capital. We raised some, but it wasn't enough to get us going. As a result of that, we had been working with an investment banker who was friendly with my co-founders, whom I didn't know, and he told us about this concept called Fundless sponsor. We didn't know what that was at the time, but he explained that if you can find an interesting deal, there are private equity funds who are willing to actually be your capital provider. We didn't really believe that that was possible because we didn't know how you could actually make an investment without having capital. And he took me on a 2-day trip to Boston to meet with 10 private equity funds, and which we did. And at the end of 2 days, we kind of had handshake commitments from these private equity funds that if we found an interesting deal that they liked, that they would be willing to fund it. And that is how we became launched as a fundless sponsor.
Well, Richard, the term emerging hasn't gone away. It's still the I guess, the euphemistic term for somebody who hasn't done a deal? Or does it have a more expansive definition today of people who might have done a deal or two?
Well, it's probably a little broader, but not much. So it's folks who haven't really done a deal or maybe have done one small deal or even come out of a search fund,
Mhm.
which I think you guys may have discussed in some of your previous podcasts.
Yep.
But we kind of call them newbies.
And you work a lot with the newbies.
It's actually become an interesting trend in the world of independent sponsors. Um, and that is for experienced independent sponsors to partner up with or collaborate with new independent sponsors. And the reason that that works is because we have found that it's not unusual for a new independent sponsor to actually get a deal under LOI. It's remarkable, but it happens. And what we find, and the analogy that I like to use is dog chases car, dog catches car. Now what? So, new sponsor can go out and get a deal under LOI. And now they realize that they've got uh, the now what is now they've got 90 to 120 days to raise capital. And for the most part, they do not have a capital provider network that's certainly not expansive enough to allow them to get a deal done uh, efficiently or effectively. They may only have a few folks to go to, and if they get turned down, they're kind of like, now what do I do? And if they partner with an experienced independent sponsor, you automatically get access to the experienced sponsor's capital provider network, as well as an experienced sponsor's expertise in how to structure a deal, how to negotiate, and all the kind of soft things that it really just takes a long time to learn if you're just becoming an independent sponsor.
I think it sounds like there are quite a few parallels here between, you talked about 20 years ago, you learned to partner with PE shops in Boston because you lacked capital. And now younger newbies are partnering with you as an experienced sponsor because they lack the same access to a capital provider network. Is it quite analogous?
That is a really good analogy, Nicholas, and I haven't heard that one made before, but I think it reflects the maturity of the asset class called independent sponsor because 20 years ago there weren't enough independent sponsors who have been doing this for 20 years. There had been a handful of them. They basically were buyout shops. And, over time now, our community has grown. And, one thing that, of course, everybody understands today is that the term fundless sponsor has disappeared and it's been replaced by independent sponsor. Um, and that term was developed by, interestingly enough, a handful of the early independent sponsors like myself who met at an early conference in 2007. It was the first Fundless sponsor conference. We got together afterwards and decided that if we were going to really do this full bore, that Fundless sponsor was a terrible name. It sounded very much like homeless person. And you're not going to get any deals done if right away out of the box you introduce yourself as a fundless sponsor. Like right away, I don't have any money. So why would we want to do business with you? So we kind of threw around a few ideas and came up with the name independence or the term independent sponsor. And people have asked us, why did you use that term? And we said, well, we kind of feel like we're completely independent. We're independent of LPs, for one. It's kind of like a two-edged sword when you have a fund. You do have LPs breathing down your neck all the time. And as an independent sponsor, you can kind of write your own ticket. So we felt that we were independent in a lot of different ways. And, sure enough, that name stuck. And so today it's independent sponsor.
Going back to the dynamic with the PE groups that you partner with, For a PE group to partner with an independent sponsor, how much better does the deal brought to them by an independent sponsor actually have to be? Because they will have to pay another stakeholder quite significant fees. And so how do you know that your deal is not just good enough to raise capital and stand on its own leg as an independent sponsor deal, but it's actually good enough to overcome that hurdle with a PE shop? Do you have some guidelines around that?
Well, so we do. We are a sector-focused independent sponsor, um, and that is becoming increasingly more important as the number of independent sponsors has grown over the years. So when we first started, there were about maybe 100 independent sponsors back in the early 2000s. Today, that number is 2,200. So the asset class has exploded literally over the last 20 years. Um, so if you're going to get a deal done with a private equity fund, it has to either be proprietary, which is kind of the best way to do it. Proprietary meaning you've seen the deal, you don't necessarily have it under LOI, but you've got enough of a relationship and enough of an edge that the private equity firm hasn't seen the deal, or if they have, what you're bringing is more than what they're bringing, other than the money. And so, obviously, each private equity firm or fund has got their own criteria. But if they want to do a deal with an independent sponsor and it's a proprietary, the only way they can do it is by partnering with you. And if it's not proprietary, then frankly, the only way you can get it done is if you're bringing enough things other than money to the party that will make them, want to work with you, or you're the best opportunity for them to get a deal done.
But can the deal be at fair market value, or does it have to be at some discount so that you offset your fees as an independent sponsor?
Doesn't necessarily have to be at a discount. Quite honestly, and a lot of it just depends on, what is each side bringing to the deal. For the most part, I will tell you that, and then this is just my opinion, that most independent sponsors um, are doing transactions at what are called value multiples. So typically, these are mid-single digit multiples, so that it can be very attractive to the capital provider. The saying in the industry is that you make money on the buy, not the sell. So when you're buying a deal at call it a 5x multiple, um, not everything has to go right. If you're going to be paying a high single digit or a double digit multiple, it's going to be really hard for anybody, but especially the capital provider, to get the kind of return that they want to get. You can consider it a discount, but it's not really a discount.
Independent sponsors need a legal team that understands the model and knows the players. Platt Richmond, a Dallas-based boutique law firm, has deep experience in guiding independent sponsors through the complexities of their acquisitions. The team at Platt Richmond provides support on all aspects of your transaction, from structuring and diligence to financing and securities compliance. They also represent stakeholders throughout the ecosystem: capital providers, lenders, family offices, sellers, management teams, which gives them a unique 360-degree perspective on the sponsor model that ensures a seamless process for your transaction. Partner with Platt Richmond to focus on what you do best: finding and executing great deals. Visit plattrichmond.com today to learn more. That's Platt with 2 T's, Platt, Richmond.com. Going back to your story, your experience of being flown to Boston and introduced around to all those private equity groups, and you ended that tour by having basically some commitments that you bring us a deal, we'll back you. Is that a model that could work today for a so-called emerging independent sponsor?
Sure. I mean, it still works because all you have is really a handshake. You don't have a deal, right? Like at
Sure.
the time we didn't really have a deal. We were just trying to understand how the model worked.
Sure.
But today, I mean, you have to, if you're an independent sponsor, or even an emerging independent sponsor, um, you have to build up a pretty large capital provider base in order to be able to get a deal done, unless you're looking for a needle in a haystack, which has got its own set of problems. Um, and you say, how many do you need to have? When we talk to emerging independent sponsors, maybe they have a half a dozen folks, or maybe they've got 10 folks, who knows? Our list of capital providers is literally in the hundreds. And we don't obviously in each deal, we have a lot of metrics about our capital providers, so we know what they like to invest in. We invest simply in two sectors, retail and what we call non-perishable branded consumer products. So we know from our capital provider network, we know, do they like to invest in retail, non-perishable consumers, or both? We know what their minimum EBITDA is before they'll look at a deal. We know what valuations they like to get. We know what their check size is. We know where they're located, because it's always better to find a local funder than somewhere clear across the country. Not necessarily, but there's about a half a dozen things that we like to know about them. So you need to take your big pot of capital providers and then boil it down to a manageable number. We typically will go out to like 10 or 15 equity providers, and we run a process, and generally the kind of the cream will rise to the top. You usually have within that group, a small handful, that's all you want, of equity providers that will raise their hand and say, I really like this deal. I'd like to learn more about it.
Yeah. Well, I guess the question for the emerging or first time independent sponsor is will they even get meetings, understanding that they're kind of sending an email and saying, hey, can we have a meeting? I don't have a deal. I've never done this before, but I'm planning to. And building that network. It's a classic chicken and egg, building the network before you've done the thing. But it sounds like the partnering with a established independent sponsor is a way to shortcut this. But short of doing that it's time well spent.
I would say kind of a hesitant yes, because most capital providers are really not interested in talking to you if you don't have a deal to show them or something to show them.
Right.
To just say, hey, we're in the business, we're an independent sponsor, we want to become active. If you talk to 100 capital providers, 95 of them are going to say, that's great. Come back when you got us a deal, when you have a deal to show us. Otherwise, don't waste our time.
This list of hundreds of investors that you guys have accumulated over time, is this a spreadsheet that you guys maintain? Can you share a little bit more about that?
There are many ways of doing it. You do need a CRM system, Nicholas, to do it. We use Salesforce, but there's something called HubSpot. There are a number of platforms that have developed in the last 20 years that are really great for independent sponsors to use. But some of the best, believe it or not, still use an Excel spreadsheet.
And then you have them in Salesforce. Do you have any system in between deals in how you keep in touch with these investors?
We do. So, out of that several hundred, probably, let's just say round number, 10% of those are folks that we like to talk to on a regular basis. What does regular mean? Kind of once a quarter. So if you say there's like 30 or 40 that you want to talk to once a quarter, just to kind of keep in touch, hear what they're working on, They want to hear what you're working on because they may want an early look at something. And so if you know, again, do the math, you know, got 13 weeks in the quarter. You know, if you've got, say, 40, you need to make like 3 calls a week. Just so it's not like a burdensome thing to do, but it's something that we feel is really important. Because a lot of times it's just being, you know, you got to be top of mind.
And you've spent 20 years growing this list and building this list in Salesforce. For emerging independent sponsors, is there a shortcut? Is there a faster way to build a pretty comprehensive investor database?
Well, I wish there were. I will tell you that some of the advice that I give to emerging independent sponsors is that you have to get out there. You're not going to be a successful independent sponsor if you're an introvert. I've had partners that were both introverts and extroverts. Fortunately, there was at least one extrovert, because you have to do a lot of networking. And so, I mean, the shortcut ways, if there are any, Nicholas, would be including, there are a number of conferences now that are held each year throughout the year by organizations that are targeting independent sponsors. And there will be anywhere from a couple of hundred folks to a couple of thousand folks attending these conferences. So just, you know, just rubbing elbows is a good way to do it because you can meet a lot of folks in the course of 2 or 3 days. Speaking engagements are also a really good way to get in front of a lot of people. Anytime you can get in front of a lot of people, it's really a good idea. So those, I think, are, you know, probably out of the box, you know, the 2 ways that, and I still use that all the time. I speak a lot at these various conferences. And even if I'm not speaking, you know, I never think that I know all the potential capital providers out there. And if I go to a conference even today, 20 years later, I'll come back with probably anywhere from 5 to 15 new contacts.
Richard, another piece of advice that you have for emerging sponsors to help them differentiate themselves or give themselves some credibility is industry specialization, industry expertise. Of course, it's, as we said at the top, it's what you had, all that consumer experience, so much of it coming into this. Talk to us about gaining industry specialization. If you don't actually have really any to speak of coming into this, there are ways that you see that sponsors can gain some industry expertise.
Sure. Let me talk, if I can, first, Will, about if you have the industry expertise, how you can maximize it.
Yeah.
Because I think it's an easier question to answer than if you don't have it, how do you get it? But I will talk about that. So with industry expertise, at least for us, that really has been our ticket to success for several reasons. One is, when you get in front of, and we work with, all of the deals that we do are family and founder owned companies that have not had any institutional investment before this. No institutional capital has been put into the business. So if we get in front of a family founder owned business that's in the sectors that we invest in, there's an immediate credibility that you gain by speaking the language. I like to say every vertical has its own language, whether it's retail, consumer, whether it's, you know, aerospace and defense, whether it's energy. And there's almost like an instantaneous bonding if the person sitting across the table from you recognizes that you understand the business and you're not asking stupid questions. So that goes a long way. In addition to that, if you have industry expertise and you want to use it being an independent sponsor, you already have an extensive network of call it almost, we call them subject matter experts that you can bring to bear with either your portfolio company or with, potential target companies that you want to invest in. We find that most family founder-owned business pretty much know everything there is to about their business. We're not going to teach them anything about their business that they don't know, but they operate with blinders on for the most part. And as soon as they have to go outside of their comfort zone, i.e., this is the way we've done it for the last 20 years or 40 years, whatever it is, they don't really know who to talk to, who to call. They don't even know how to find out who to talk to. And we bring that instantaneously to the company because we've got usually 2 or 3 subject matter experts in each subject. So for retail or consumer, it's things like inventory management, sourcing, branding, digital marketing. The list, there's, like 10 or 15 of these different functions that are really important. And I think once you have a portfolio company, it helps more because you're bringing so much value. This goes back to your earlier question, I think, Nicholas, about how do you get them to trust you, believe in you, go pick you, whatever. It's all about how much value can I show that I've added. For someone who doesn't have the industry expertise, it's really hard. Well, I don't know how you develop it when you don't have it, because presumably that's what you spent the earlier part of your career, whatever you have done. And even, emerging independent sponsors are not right out of college or right out of business school. Those become the search funds. But most of the emerging independent sponsors that we talk to have already had a career or two, oftentimes in finance. Maybe they're in investment banking. And if they were investment banking, they developed some sector expertise because they were a consumer investment banker or an energy, whatever it is. And so you kind of look inward or look in the mirror and see, where do you have expertise, and then try to maximize that as you're becoming an independent sponsor.
Industry expertise, is it different, the importance of it or the defensibility of it? Is it different today from how it was 20 years ago when you didn't have the internet and AI in the same amount as you do today? Because today it feels like everyone can access knowledge and expertise at least faster than before. Have you noticed a change?
Believe it or not much. Because I think still, not every AI is good, and it's a tool, but it's not necessarily a strategy. And there's still this human element of how can you replace 35 years of, call it, retail and consumer experience with an algorithm? You can't do it. And still, even doing these deals, it's still kind of face to face. So there's issues of trust and credibility, and chemistry is so important at the end of the day. I mean, chemistry is one of the most important elements in the process with your capital provider as well as with the company. And that can't be replaced by an algorithm.
It's challenging, I guess, for some independent sponsors or emerging independent sponsors, Richard, because if they don't have an industry expertise, or if they do have an industry expertise, but they just don't believe that investments in the category where they have their expertise is good, or where they want to spend their time. So when from the independent sponsors we've talked to, we certainly know a lot and have invested in a lot who came from a category and are doing deals in that category according to the formula you just described. But a lot of sponsors, if you go to McGuire Woods, they're not looking. Their target is not where they come from, but the kind of the cliche characteristics that make a good, boring business: the recurring revenue, et cetera. So it's more of an observation by me than anything, that as logical as you make it sound that somebody should turn their attention to the industry from which they come. It doesn't happen as much, in my observation, as you'd think it would.
It's probably the case. I just think it's more difficult for those kinds of folks, if they're trying to invest in a new industry. But I'm not sure what the exact numbers are, but in my view, let's just say 80% of deals that independent sponsors actually do fall into 4 verticals, 4 or 5. So they do light manufacturing, value-added distribution, healthcare, and services. So either business services or consumer services. Because those have the characteristics that you just talked about. Well,
yeah.
Recurring revenue, they're asset light. And while that's a good thing, the problem with that, or the challenge, is that that's what 80% of the independent sponsors are doing. So now you've got, say there's 2,000 independent sponsors, 1,600 of them are all chasing the same kinds of deals. And there's a lot to go around, for sure, because if you look at, at where what these small businesses are, there's a lot of them, but I doubt there's enough to support 1,600 independent sponsors.
Well, Nicholas and I and our third partner, Max Lummis, were just having this conversation around consumer. We interviewed a sponsor who focuses on consumer, not unlike you guys, and how we feel like it gets such a bad reputation that probably is undeserved. And if nothing else, there's a supply-demand dynamic where at least in consumer, there aren't going to be as many people hunting. It does have that going for it, if nothing else. Whereas the classic B2B services business, as you said, recurring revenue business, everybody wants. So it's going to be harder to get your hands on.
Well, that's a really good observation, Will. And I will tell you, I totally agree with it, just through my experience. The negative side of consumer retail is that oftentimes there's not recurring revenue if it's retail. There's a fashion aspect to the business, which means you may have to reinvent yourself, every season. You may not have bulk purchases of things, particularly if it's retail. So there's just some of the negatives, and there's kind of a saying in the industry that private equity doesn't like the 3 R's: retail, real estate, and resources, meaning natural resources. So those are kind of the 3 no-nos. The flip side is that because of that, and also because there are fewer folks that are interested in it on the private equity side, is that the multiples are low. So you can get a retail deal done for 3 to 6 times EBITDA. And there's other sectors that, you could never go that low. And part of it is because there's so many people chasing it that somebody's going to bid up the price, and the highest price is going to win. And that's true whether it's an independent sponsor or, an auction process. Our auction processes, by the way, we participate in those. Why? Because there's usually not a lot of participants. We'll hear, we have a select process. We know they have select processes when it comes in our sector because there just aren't that many people to go to.
We had discussed this very fact, but doesn't it then on the exit, the low end, the low multiple you got on the way in, you're also going to see multiples depressed on the exit side of your investment, so it kind of cancels out?
Okay, so here's what I would tell you. I wouldn't use the term depressed. I would use the term value.
Okay.
So you buy something at 4 times. So your hope might be Well, two things can happen. Two good things. One is you buy it at 4, you sell it at 4, but in the interim, you've doubled or tripled the EBITDA in the business. So that would be a good thing because then you would have a double or a triple on your money, right? The other thing that can happen is that you take that business and you really turn it into a nice growth vehicle, and you do get multiple expansion. So now instead of selling it at 4 times, I double or triple the size. And now it's a bigger business. It's more attractive. More people will be interested. Now I can get a 6 multiple. Still pretty good. But if you do that math, now I've basically, done like a 6 or an 8x on my investment.
Yeah.
Richard, across 20 years in the lower middle market private equity space here, have you observed that the return profile of consumer has been categorically different from what you've, for instance, seen in light manufacturing or healthcare?
Well, I don't do light manufacturing or healthcare, for one, so I'm not really the right person to ask that question to. But my guess is if you do apples to apples, the returns in retail and consumer can be equivalent to the returns that you get in the other sectors. What we run up against, Nicholas, is that from time to time, we'll talk to a private equity firm and they'll say, we invested once in consumer and we lost all our money. So we don't invest in consumer anymore. So they're painting consumer or retail with a very broad brush.
Right.
But there are a number of enlightened investors, I'll use that term deliberately, who kind of, they kind of see the glass half full instead of half empty. And, they understand that you can make really good money in the sector. A lot of things have to go right, but a lot of things have to go right with every investment that you make, no matter what the sector is.
Well, that broad brush point too is, I think, bears repeating in this conversation I keep referring to. So our guest had invested in Ace Hardware, a portfolio of Ace Hardware stores. And hardware stores are a frankly very old-fashioned business. The demand for that is long-standing and durable. There was some threat there from Home Depot and Amazon, but it's come out the other side, and it's probably here to stay. So and versus, as you said, sometimes consumer is kind of conflated with trendy or fashion, which is by definition something that's passing and going to be here today, gone tomorrow. So you can at least take that more nuanced view of retail, the enduring style of retail businesses versus those that are associated with trends. But for whatever reason, it seems like consumer is broad brush associated with trendiness and fashion, which it doesn't have to be.
That's true. So I'd like to make a couple of points. So since you mentioned Ace Hardware, I will mention Ace Hardware. So so my understanding of the Ace Hardware concept is that it's franchise concept. So when you own a portfolio of Ace Hardware stores, you're a franchisee. We don't invest in franchisees. And the reason that we don't invest in franchisees is because, and everybody knows this, but when you're buying a business, one of the things that you need to consider is, how am I going to exit this thing? When you're a franchisee, even a group of franchisees, whether it's Ace Hardware, Planet Fitness, all these restaurant concepts, they're usually like only 2 exits. One is you can sell it back to the franchisor because they've got first dibs on it anyway. By the way, and if it's doing well, they'll buy it back. If it's not doing well, they won't. And then your choice is, I got to find the next dumbest franchisee to buy my group of stores or locations. So your exits are very limited. In our case, we hope that we aspire to grow a business to the size where there is a next level up of private equity funds that like to buy larger businesses, and hopefully those are the ones that we have grown to a decent size, or a set of strategics. And so there's a handful of strategics who are really good and like buying some of these, what we would consider to be larger businesses, but they would consider to be smaller businesses. Like, we like to buy a business that's probably somewhere between 25 and 100 million in revenue. If we can double or triple that, now we've got an asset that can really command a lot of interest. And so that's always what our goal is.
And Richard, just circling back to the franchise point. By the way, Ace Hardware is a co-op, often mistaken for a franchise. There might be some similar dynamics there.
Yeah.
But just broadly, though, your point about there being a limited pool of buyers, just why couldn't another larger private equity buyer be a viable buyer for an independent sponsor and a franchise system?
Oh, they would.
Okay.
Oh, no,
Okay.
you definitely could find another private equity firm to do it. Absolutely right. That would be the third option, which is
because
probably
we observed that it seems like there's an increasing comfort with franchise investing among independent sponsors and private equity broadly. I don't know if you've seen the same.
We have, Planet Fitness there's some that are pretty high profile.
Sure.
Yeah, absolutely agree.
Richard, we don't have you for very much longer, but still got a couple topics we want to get to. Would love to hear a case study from your investing. But first, still on the strategy of an emerging sponsor getting in the game, working as a strategic advisor, advisory work, that was something that you're a big fan of. Can you expand on that?
Sure. So when you've got industry expertise, and we kind of fell into this, but there's another part of our model where we do provide, we call it strategic advisory services, SAS. So we see, we probably see 50 to 100 deals a year, order of magnitude. And we also have good relationships with about 5 to 10 boutique M&A firms that specialize in retail and consumer. And they're seeing several hundred opportunities a year. And they can only do a limited number of those. So if you take a good boutique M&A firm, maybe they'll see 200 or 300, and maybe they can do like 10% of those, maybe even less, 5%. So in that 95% that they're not going to do, there's some pretty good companies in there. But for a variety of reasons, the M&A firms saying, we'd love to represent you when your sales get to X and your EBITDA gets to Y. So what they've told that company is that the equivalent of your child is ugly. We've told them that in a nice way. But they've also told them what beautiful is. They've said, when your child gets to X in sales and Y in EBITDA, we would love to represent you. That's beauty to us. What they haven't told them is how to get from ugly to beautiful. And in our strategic advisory services, that's what we do. So they will refer these companies to us. And again, this is from the dialogue that I have every 3 months, because they're always seeing companies like this. So we kind of say we're like the plastic surgeons of the sponsor world. we can help the company get from ugly to beautiful by improving their operating business, help them improve their profitability so that they can get to a stage where they can do an interesting deal and can have a very good outcome. Um, and then the same thing happens just with companies that come across my transom because I get introduced. I see 50 deals, and some of them are just not ready for me as an independent sponsor for those same reasons. And I will even offer, propose, whatever you want to call it, to say, hey, I think you guys are going too early. I think you need like maybe a year or even two to get to where you can have a better transaction. And so over time, our model, which includes these strategic services, are annual retainers, generally with no specific deliverables, but we'll do whatever the company needs to get done to get from where they are to where they need to be. We will do either ourselves or through our network, as I talked earlier about subject matter experts, introducing them to great folks who know how to work with, call it lower middle market companies that can provide the services that they will need.
But this is not only something that you guys do successfully, but something you recommend to others, emerging sponsors, to spin up advisory services, maybe not something as established as what you just described, but as a way of building a track record in the industry, as a way of generating network and deal flow, right?
Well, it does those two things, but there's two other things that are really important, Will. One is, if done right, it can turn into a proprietary deal for you as an independent sponsor.
The client itself.
Yeah, because if you work with a company for 2 years, you probably know more about the company, as much about the company as the owners do, because these are pretty, they're intense advisory engagements. And the other thing that it does, particularly if you're an emerging independent sponsor, you generally don't have any income until you do a deal. You've left your job. Now I'm going to be an independent sponsor. It can take you anywhere from 18 to 24 months to do your first deal. It's really nice if you can put some food on the table in the interim. And that, interestingly, is what got me through COVID, because there weren't a lot of deals done in consumer and retail during COVID, but I did have half a dozen advisory clients that I was working with to help them get through COVID and come out the other side, because if you survived, you were a winner.
Mm-hmm.
And so that was a win-win, because it really did put food on our table, even though we'd been doing this for many years.
Richard, for our last segment here, could you share a case study or a deal you've done at Consumer Growth Partners as an independent sponsor with the audience?
Sure, I'd be happy to. So I think one of the deals that kind of had the best outcome for us was a deal that we did. It was actually our second deal. So we did it back in 2009. It was a family-owned Western wear and workwear retailer that had about 15 stores. And it was family-owned. It was on its third generation. The business was actually founded in the early 70s. And it was being run by one of the nephews of the founder at the time. And it was actually owned by, believe it or not, it was actually owned by a private equity firm. So it was a little bit of an unusual deal for us, but they were kind of flippers. They liked buying these deals that were down and out and dressing them up. and then selling them. That's how they made their money. It was a good model. They're still in business today, very successful. But the head of the firm that owned the business, I met at a seminar where I was speaking on becoming an independent sponsor, and he came up to me afterwards and said, I think we might have a business. I think we have a business that you might be interested in. And it was this business. They had 15 stores at the time. It was profitable, but not wildly profitable. They had dressed it up enough. And we ended up buying the business with some SBIC investors. SBICs, as you probably know, are very good partners for independent sponsors. That can be a whole other topic about why they're so great. But we needed to bring in, and we brought in an outside CEO. They were comfortable with that. The company was comfortable with that. And we essentially on our watch, we doubled the number of stores and we tripled the EBITDA. And this is a deal that we bought at, under 5 times. And there were, we were actually approached by a strategic. There was actually a private equity strategic. So they were, had a fairly large business in the space already. But they weren't in Texas, which is where we were. So it's kind of hard to be a successful Western wear retailer and you're not in Texas. And they wanted to come into Texas. And I actually knew them and had a conversation with one of the managing partners and said, well, you guys can come into Texas, but there's us to deal with, but there's also another family-owned business that is really strong and successful. So it won't be the easiest. And that company didn't want to sell. But when our funded sponsor, found out, they were like, well, we should pursue this because we wouldn't mind having an exit to somebody like this. So initially they were like, we're going to come in on our own. And then, there was some language back and forth that I cannot repeat on this podcast. But we eventually said, it's easier for you guys if you just buy us. So they thought about it for a while. It didn't take them too long to come back. They gave us an offer. It was a multiple that was more than twice what we paid for it, just on the multiple side. And they subsequently, after we bought it at mid-single digits, sold it at high single digits, they ended up taking their business with our business, and they ended up taking the company public at 17.5 times EBITDA. So this is a win-win-win. And the folks that were the most upset were our management team, because our management team felt that we exited way too soon. And we had to explain that it wasn't really our choice. It was our investors' choice, because they wanted to raise another fund. And sometimes if it's one of the last portfolio companies in a fund and they want to raise another fund, they need to have an exit. So they're very happy to take that exit. And our management team, whom we were quite close to, subsequently, they left because after a relatively short period of time, they became an independent sponsor. So this was like win-win-win. Everybody won.
Richard, just to think about investing in consumer really quickly, what was it that you saw in this brand which was not thriving, not surging, that you liked?
So we always like to find companies that are pretty nichey. So we stay away from. We don't invest in things that are mass oriented. So we don't invest in companies, for example, that are selling uh, to Walmart, or even Costco will take some, but we like things that are more specialty, called specialty retail.
Mhm.
And this was a category that had been kind of sleepy for a while. It hadn't really come into its own. It subsequently did, oil boom and all that kind of stuff. Um, but we just felt that it was certainly, and we were more in small towns. We weren't necessarily in the big cities. So none of our stores were, they weren't in Dallas, Houston, San Antonio, Austin. They were in Huntsville.
And so what did that tell you?
That there was really opportunities to expand this into across small town Texas. There was a demand there. There wasn't a lot of competition in these towns, and our big competitor was really opening in some of the larger metro areas. So we thought, from a competitive standpoint, it wouldn't be as difficult as some of the other deals that we look at. And we felt that we could find the management team because um, that's one of the things that we're able to do because of our extensive contacts, network, Rolodex, whatever you want to call it. So we were able to find a really fabulous CEO to come in and run the business, who had already had experience running um, a jeans business, big jeans retailer. He'd run a big chain of bookstores. He was kind of a specialty retail maven. And we knew that, with our backing, he could definitely grow this business pretty rapidly.
And Richard, your preference for specialty retail as opposed to more mass retail, what is that about? Is that just what you know, or are there stronger fundamentals to those businesses in some way?
Well, it's a bit of both, Will. I'll say it's what I know the best because I've spent, most of my years doing specialty retail. Even when I was an analyst, I was not covering, the big mass retailers. I was covering the specialists. I did probably 15 IPOs during my 15 years. Um, and, many subsequently very successful apparel and accessory retailers, footwear retailers, jewelry, you name it. Um, and it's also a little bit easier to get traction with specialty than it is with mass. Mass has just got a lot of the competition is very intense in mass, and you've got to be able to handle the competition as an independent sponsor, because if you go up against some of these really big guys, you at any moment can get crushed.
Yeah.
So I think most independent sponsors are doing kind of niche businesses that are in the lower middle market, which, again, probably less than 100 million in revenue, and usually kind of 3 to 15 or 20 in EBITDA.
It also strikes me that in mass retail, you have what you might call platform risk in an e-commerce context, which is you got the big guys of Walmart and Target as in Costco as kind of the primary channels.
Yep.
And so they hold a lot of sway over your pricing and sell through and so on, versus a Western wear company that is independent and has its own brick and mortars, and you can just open as many as you can find markets that will take it.
We like that a lot. We like brands in particular. We like to invest in brands for that very reason. So they control their pricing. They generally are not selling on Amazon, or if they are, it's, a relatively small amount. But it's just like small likes small, medium likes medium, large likes large.
Hmm.
So let's face it. I mean, independent sponsors are small. We're not called lower middle market for nothing. And
Okay.
the sooner we recognize that, the better off we were.
Okay. Well, we can end on that point. Richard Baum of Consumer Growth Partners, we really appreciate you joining us on the Minds Capital podcast. Your reputation precedes you, so we were thrilled to get you here. Thanks for your time.
Well, thank you, Will. Thank you, Nicholas. It was a real pleasure, and I hope your audience enjoys this.
Thanks, Richard. Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital podcast wherever you listen to podcasts. You can also watch us on YouTube. Also, check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraisers. See you in the next episode.